Welcome back to the Real Estate Play-by-Play.
So epic comeback. So I have to tell you, Danielle, I was in Washington last week. I took my boys up there for their AU travel basketball. And we went and saw the Washington Gonzaga game and in Washington. And the whole time Gonzaga was ahead. And but Washington was gaining on them. And towards the end, they gained on them and they ended up winning. And it was a huge upset.
Yeah.
And, the team that wanted it more won.
Yeah.
We were rooting for Gonzaga, the WCC, but at the end of the day, Washington won because they wanted it more.
Yeah.
And in that situation, when you have an epic comeback, there's strategies that are involved to get you to where you want to be, which is at the end of the game to get that W.
Right.
And it's the same in real estate.
Same in real estate, right? And, it's been an interesting year in real estate as we kind of tie up the end of 2023. It's been a really interesting year. Mm-hmm. And it's easy, I think, for buyers to get disheartened with the state of the market, with interest rates having risen, more quickly than they have in any previous time period. It's easy for buyers to get discouraged. Mm-hmm. And I think that sometimes buyers lose sight of the goal. The goal is to win. Sometimes we need strategies so that they can really accomplish those goals and win on all terms.
Right. And, buying down the rate has been something that has come up.
Yeah.
And I feel like a lot of buyers and sellers don't understand fully what that means to buy down the rate, whether it's short-term, long-term, if it works for them, if it doesn't work for them, the pros and the cons. So we're going to dive into buying down the rate today.
Yeah. Yeah. I think it's an important conversation, right? And in the last probably 30 days, we have seen interest rates reduce just a little bit, which has been positive and awesome. But it still makes, home prices, they haven't really gone down in the last year by any significant degree. And interest rates have gone up to the point that affordability is an issue. So we have solutions for affordability because at the end of the day, the goal is buying the house before the competition starts.
Right. And the second the rates start going down, that's when the competition is going to start. And, and as you mentioned, the rates, came down a little bit in the last few weeks and we saw a lot more buyers out. Our open houses were a lot busier.
Yeah.
So you could imagine the prediction is towards the end of 2024, the rates will start going down even more, maybe multiple rate drops throughout the year. But, you get down into the mid fives from where we were at the eights and you're going to have a lot more competition. There's a lot more pent up demand.
Yeah.
So, right now really is a great time to buy. And sometimes you just need a little bit of a strategy to make it happen, to get that property, just like in the games when you play. You need a good strategy if you're losing, to get that W.
Right.
So what is buying down the rate?
Yeah, good question. So, and there's all kinds of different types of rate buy downs. But, essentially, interest rates themselves never really change. And they are always sold with or without a cost, right? And the market dictates how much that cost changes. So let's use 7% for an example of an interest rate. 7% today might come with credits, meaning that the lender actually pays you to take that interest rate. Whereas 3 months ago, 7% might have come at a cost where the lender charges a fee to buy that interest rate. And so when you're looking at qualifying for a mortgage and you're looking at buying a house, you can structure buying down your interest rate in a number of different ways to accomplish a lower interest rate.
And when they say buying down short term versus buying down long term, what's the difference? What does that mean?
Yeah. So in the last probably year and a half, temporary rate buy downs have become very popular. So a temporary rate buy down can be structured up to 3 years. So you have a tapering, so to say, of interest rates. So let's say the market interest rate is 7% on that house. If you do a 3-year temporary buy down, the interest rate for the first year of the loan, or actually more the monthly payment for the first year of the loan, is 3% lower. So 7% would turn into 4%.
Okay.
Year 2, it goes to 5%. Year 3, 6%, and then it adjusts to the full payment. Now, it's really important to know that this is not an adjustable interest rate, because I know people have heard all kinds of bad things from the 2008, days of adjustable interest rates. The interest rate is fixed. It's a fixed rate loan. You are just being allowed to make a monthly payment based on that lower interest rate, but it's fully funded by either the seller or the lender. So there are ways to structure it so that the lender will fund that for you. But generally speaking, it's funded by the seller.
Okay.
And so, essentially what you need is a seller credit, right? So from a seller's perspective, let's say you're buying $1 million house and you need this temporary buy down, you're probably looking at about $20,000 roughly needed of seller credit, which will then give you a lower monthly payment for the first 3 years of the loan. Now, that can be really beneficial because it can help you ease into homeownership, right? It might help you stretch your budget. You still have to qualify at the full interest rate, so that's important to know. But it'll allow you to kind of ease into that monthly payment. Also, all of the indications are that interest rates are going to drop over the next year. And so potentially there's an opportunity to refinance in the future where you will never maybe make that 7% interest rate payment, which is huge.
Right. And I think where this comes into play as a realtor is, when you're trying to bridge the gap to make a transaction happen and ratify a contract, and there's a certain dollar amount between the two,
right?
This is a really good bridge. So, for example, using your example of $1 million property,
right?
Say I have buyers that don't want to pay over $950 for the house,
right?
And so they write an offer at $950,
right?
The seller could come back, as opposed to dropping the price $50,000. The seller can come back and say, "Hey, listen, we'll buy down the rate for you. It will cost us $20,000, which is it's going to less than them, less $30,000
cheaper for them. Yep.
But everyone reaches their goal, because at the end of the day, the buyer doesn't want to buy the house at $1 million. Most likely because they're looking out for their monthly payment how they're qualifying and everything.
Right.
So buying the house at $950 or buying the house at $1 million, but having the buy down still keeps them at their monthly payment. Yeah. Then you're able to bridge that gap, make the transaction happen. And at the end of the day, you just want your buyers to get the house.
Right. And from a buyer's perspective, in that exact example, a $50,000 price reduction is not going to change their monthly payment all that much. A couple $100 a month, maybe, depends on how much down they're putting, but a 3% interest rate reduction for the first year on their payment is going to save them a ton of money. So from the buyer's perspective, it's a better situation for them. It gives them an opportunity to get into the home. And, sometimes it's not even just payment relief. It's the house needs work, right? And so having a monthly payment that's lower for the first 3 years allows them to reroute that extra cash flow into making little repairs, home improvements, paint, cosmetic stuff.
Right.
So that they create some extra cash flow. And then all of that money, so the seller funds the temporary buy down for this example. We use that $20,000. It basically sits in an escrow account and it supplements that monthly payment each month, right? So the monthly payment is really 7%. But the lender is charging it based on the 4%, and it's being supplemented out of that escrow account.
So that 3% difference is coming from that escrow account to pay
the seller has paid for it. It's sitting in an account. So let's say year 2, interest rates have dropped and they get an opportunity to refinance. Well, they will have not used all the money in that escrow account because they wouldn't have spent the full 3 years. Whatever money is still in that escrow account gets credited back to them. So they don't lose it.
Okay. That's
now,
good to know.
that is the big difference between a temporary and a permanent buy down, is that money is not gone.
Okay.
So now when you talk about a permanent buy down, that is essentially just paying points on the loan. So you can do that at any time. It doesn't require any involvement from the seller. You can pay an upfront fee in order to get a lower interest rate.
So for example, if you're getting a 7% fee and it costs, let's say $25,000 to buy down to 5%.
Sure.
If that's probably cheap. Is that on the cheaper end?
It just depends, right? So the market shifts, but let's use those numbers. So let's say it's $25,000 worth of points to buy the rate down to 5%. That'll be a permanent buy down. That interest rate will stay at 5% forever for the life of the loan. The calculation that I advise our clients to make, we'll obviously make it for them and help them walk through it,
right,
is a cost to recapture calculation.
So the difference between the 5 and 7%, how much time it's going to be to make up the money that they'd be paying.
Exactly, right? Okay. So let's just use totally inaccurate math, but let's say that saves them $500 a month and they're paying $25,000 at closing to accomplish that. You would take that $25,000, divided it by the 500. That'll tell you how many months it will take before you end up even on the trade.
Yeah. And I can see where your knowledge of the market would come in really handy in that situation, especially knowing, like, for example, if I have a client that's going to buy down the rate to 5% off of 7%, and it's going to take them 4 years to get that money back. But all the economists are saying that rates will probably drop by 2025 to 5%. That's only 2 years away. Doesn't necessarily make sense to buy down the rate.
Yeah, 100%. You totally nailed it. So that's where working with someone who has experience and is following, the market trends is really important because, truthfully, I wouldn't recommend most clients buy down a permanent rate buy down today. Knowing that interest rates will drop in the future, they will get an opportunity to most likely refinance.
Right.
And then they won't have to pay those points. Because once you pay those upfront points, that money is spent. There's no refunds. You bought your 5% interest rate and, you could keep your loan for 30 years, but you may not have to pay those points. 5% could be back, without having to do that extra cost.
Yeah. So really knowing and having that good relationship with your mortgage broker and your realtor and being able to talk it through to figure out what makes sense for your individual needs as a buyer. Now, on the seller side, I've had sellers that have come to me and said, well, what about we offer a short-term buy down to get the house sold?
Yeah.
And I would say there are pros and cons with that. Yeah. So from a realtor's perspective, if I'm listing a property at, like, let's say 1.5 million and it doesn't sell, okay? My properties always sell. But let's just say somebody else was listing a property at 1.5 million and it's not selling.
Right.
Theoretically speaking, the seller can come to them and say, why don't we offer a short-term buy down? Yeah. So instead of reducing the price to, let's say, 1.4 by $100,000,
right,
let's offer them a buy down in their rate. Now, you can do that. The negative is, from a realtor's perspective, is buyers don't search by confidential remarks of the MLS. They search by price point.
Right. Yeah. There's no search option to be like, how much are you going to buy down my interest rate?
So that makes it a little bit more challenging, right? It makes it a little bit more challenging,
right?
In terms of how to market it. And I think that strategies around how to market a buy down comes up time and time again. And I think that's where it gets a little bit more challenging. And so people aren't as aware of these buy downs because it's not marketed as much, because it's challenging to market it.
Yeah. But that is generally when I see it come up, is when a property has been on the market for a little bit of time and a buyer comes in and wants to make an offer that's substantially less than that offer price. And you get kind of a resistance from the seller, obviously, right? They don't want to come down that much. And so that's usually when we propose some buy down options to kind of meet in the middle.
Right.
The buyer will benefit more from that monthly payment, having the rate buy down, than they will for a price reduction. And so a lot of times it's better for everyone involved.
Mm-hmm. I mean, it's a great strategy. Listen, if you're trying to bridge the gap and you're trying to get the house and the sellers have in their mind what they're only willing to sell the house for, it's a good strategy to talk to your agent about in regards to buying down the rate.
Right. Yeah. And there's other reasons that you would want to buy down the interest rate that don't have to do with the price of the house, right? Sometimes you have someone who is union, for example, and they work in the union and they know that they have a guaranteed raise coming in a certain period of time, oftentimes a temporary buy down can help them, afford the house today, knowing that they're going to have, often a substantial pay increase in a set period of time. Their payment will slightly escalate in that time period, which allows them to buy today, because that's the big problem. Waiting generally costs you more. And
I would
it's
agree.
a hard concept to grasp. I have all these buyers who, when interest rates increased this year, they kind of went, whoa, we're just going to hold off and see what happens.
Yeah. So I had a client the other day email me and say, I think we're going to wait till the spring.
Yeah.
And I said, actually, right now, if we can find you a property is probably the best time to buy.
Right.
Because even though rates are a little bit higher, there's less competition. And if you can get into a property at, let's say 7%, and in a year from now or a year and a half from now, refi to 5.5% or 6%, it makes more sense to buy at a little bit higher rate where the purchase price is affordable than getting into a situation where the rates have dropped. All these buyers come out because of pent-up demand. And now you're competing against one house with like 15 offers,
Right. And we saw that. We saw that in, 2020 when interest rates were dropping in the, sub 3%. The demand was absolutely insane.
Yeah. I mean, buyers were having to remove all their contingencies. They would go in and look at a house and they'd have to make an offer that day.
Yeah.
It was challenging. It was
price.
Stressful for buyers.
Right.
So
it's like you're buying a house on sale now with, only 4 other people shopping at the same store, then getting flooded with, every other person in town. There are so many people who are waiting for rates to drop that as soon as it gets to a point, I think kind of mid 5s is probably going to be the number that catches the headlines. It's going to be insane.
Yeah.
I mean, I'm mentally preparing for it already again, because it's going to be insane. Now, the Feds came out this last week and said that they were intending to drop interest rates 3 times next year, 2024. The Feds control short-term interest rates, but they do tend to correlate with mortgage rates. So those Fed rates that you see in the news are not necessarily mortgage rates themselves, but it does signal that inflation is slowing, and that will in turn relate to lower mortgage rates. So we have the data to really document that interest rates are going to be dropping in the next year.
Yeah. So if you're able to buy right now, even if it means doing a short-term buy down, get the house now sooner than later.
Yeah.
When there's less competition.
The goal of the game is to win.
Yeah. Get that strategies out and win the game. Epic comeback.
Epic comeback.
Real estate play-by-play.